starting the last day of February. No hedging quota, no delivery allocation, 0 lots. At the same time, silver adds $297 billion in just 12 hours. Shanghai trades at a premium. Western vaults keep draining. 20 exchange accounts suspended in 1 week. Bloomberg quietly admits supply constraints. Paper says one price, physical says another. So the real question isn't whether silver is volatile. The real question is, what happens when delivery is demanded and the metal isn't there? Welcome to Market Metal. If you're over 50, if you've seen cycles come and go, if you know markets don't move by accident, then this channel is built for you. Subscribe, not because of hype, but because experience deserves real data. And before we go deeper, tell me in the comments, where are you watching from today? The event, what actually happened in 12 hours. When the data refreshed that morning, it did not look dramatic at first glance. Silver had moved before, it had rallied sharply before, but this time the numbers carried a different weight. In just 12 hours, roughly $297 billion was added to the global silver market's value. The speed of that change forced serious observers to pause. Markets do not reprice hundreds of billions of dollars in half a day without reason. He did not treat it as excitement, he treated it as a signal. The first task was to separate fact from noise. The surge was not simply a retail frenzy. It was visible across spot markets, futures contracts, and exchange-traded vehicles. Liquidity increased sharply, trading volumes expanded. Bid-ask spreads tightened and then widened again as volatility accelerated. The price climbed rapidly, then consolidated at higher levels. The movement was broad-based, not isolated to a single exchange. The speed mattered more than the percentage. In financial markets, magnitude attracts headlines. Velocity attracts professionals. A 7-8% move over months is a trend. The same move inside half a day suggests urgency. It suggests capital rotation. It suggests that someone large or many large participants at once decided not to wait. They began by asking a simple question. Was this speculation or was this structural demand? To answer that, they looked beyond price and into positioning. Futures open interest remained elevated. Coverage ratios between paper contracts and registered physical supply remained tight. At the same time, reports showed continued drawdowns from Western vault inventories. Physical metal was leaving storage facilities at a steady pace. That combination is unusual. If price rises only because of speculation, inventories often remain stable. If price rises because of physical tightness, inventories tend to shrink as delivery pressure increases. In this case, both trading intensity and physical movement were visible. That dual signal increased concern. He then turned to geography. Silver was not trading at a uniform global price. Eastern markets were pricing physical metal at a premium relative to Western futures benchmarks. That premium was not enormous, but it was persistent. Persistent premiums often indicate regional supply stress or delivery preference differences. The question was not whether a premium existed. The question was why it existed during a rapid global repricing event. Markets tend to equalize quickly when arbitrage opportunities appear. If a commodity trades higher in one region, traders typically buy where it is cheaper and sell where it is expensive. But when premiums persist, it may signal friction in delivery logistics, regulatory restrictions, or increased demand for physical settlement over cash settlement. That distinction matters. Silver is not merely an investment asset. It is a critical industrial input. Solar panels, electric vehicles, semiconductors, telecommunications systems, and advanced electronics all rely on silver's conductivity and durability. A sudden repricing affects not only traders, but procurement managers, manufacturers, and supply chain planners. When $297 billion flows into silver in 12 hours, executives in manufacturing sectors must ask whether forward contracts will become more expensive. They must evaluate whether suppliers will adjust pricing or demand stricter delivery terms. They must ask whether this was a temporary spike or an early warning. He compared the event to prior episodes of rapid commodity repricing. In 2008, commodities surged before collapsing as liquidity evaporated. In 2020, precious metals rose sharply as central banks expanded balance sheets aggressively. In each case, the underlying driver differed. One was leverage stress, the other was monetary expansion. So what was driving this one? Monetary conditions remain loose relative to long-term historical standards. Sovereign debt continues to grow. Real interest rates fluctuate but remain sensitive to inflation expectations. In such an environment, hard assets often attract capital as hedges against currency risk. However, currency hedging alone rarely produces a 12-hour surge of this size. The more plausible explanation was capital repositioning under urgency. Institutional investors may have shifted exposure rapidly. Funds may have reduced risk in overextended equity sectors and rotated into hard assets. Alternatively, algorithmic strategies may have triggered momentum thresholds that accelerated buying. but the physical component complicated the explanation. Reports indicated steady vault outflows and ongoing interest in physical allocation. That suggests that at least part of the surge was not purely digital speculation. It may have reflected underlying demand for metal that can actually be delivered. This is where serious observers become cautious. If silver's price rises because of speculative leverage, it can reverse quickly. If it rises because the physical market tightens, reversals become more difficult. Industrial demand does not disappear overnight. Solar installations do not pause because futures markets fluctuate. They then examined volatility patterns. After the initial surge, price action stabilized at higher levels rather than collapsing immediately. That stabilization indicated that buyers were not instantly retreating. Instead, they were defending higher ground. That behavior is often seen in early stages of repricing cycles. Still, they resisted dramatic conclusions. Markets can mislead. Short squeezes can exaggerate movement. Temporary delivery fears can subside if supply chains normalize. It is possible that this surge will look minor months from now. But responsible decision makers do not ignore signals simply because outcomes are uncertain. For entrepreneurs and business leaders, the relevance is practical. If silver remains volatile, production costs in technology and renewable sectors could fluctuate. If premiums widen, procurement strategies may require revision. If leverage in derivatives markets remains high relative to physical supply, future delivery stress could amplify price swings. In short, this was not only a trading story, it was a supply chain story, it was a capital allocation story. They understood that markets rarely move this much this fast without underlying tension. The tension may be monetary, it may be geopolitical, it may be industrial, it may be a combination of all three. The $297 billion figure is a headline. The underlying shift is the real issue. And the central question remains open. Was this a short-term shock driven by momentum, or the first visible sign of a deeper structural repricing in silver's role within the global economy? That answer will determine whether this 12-hour event becomes a footnote, or the beginning of something larger. Structural forces. Beneath the surge. The 12-hour surge was not the real story. The real story was what forced capital to move that fast. He understood something that many casual observers missed. Markets do not reprice a strategic metal by nearly $300 billion because of a headline. They reprice when pressure builds quietly beneath the surface for months, sometimes years, before finally breaking through. Silver did not wake up and decide to rise. The system around it changed. The first layer was monetary. Global debt has not slowed. Sovereign borrowing continues to expand across developed economies. Central banks speak of discipline, but balance sheets remain historically large. Real interest rates shift with inflation data, but structural debt remains elevated. When debt expands faster than productive growth, currencies weaken over time, even if slowly. Serious capital sees that pattern early. They do not wait for crisis language. They reposition gradually, then suddenly. The surge in a silver may not be about silver at all. It may be about confidence. When investors begin to question long-term currency stability, even quietly, they rotate into assets that cannot be printed. Silver, like gold, exists outside central bank policy. But silver carries a second layer that gold does not. It is not just money, it is infrastructure. Solar installations require it. Electric vehicles depend on it. AI data centers use it. Telecommunication systems rely on it. Military-grade electronics need it. Demand for silver is not purely financial. It is technological and structural, and that demand has been rising steadily. Mining supply, however, has not kept pace at the same rate. Large new discoveries are rare. Permitting timelines grow longer. Environmental regulations increase project costs. In many regions, silver production is a byproduct of other metals. That limits rapid supply expansion even when prices rise. This creates a silent imbalance. When demand grows structurally and supply grows slowly, the gap widens over time. Markets often ignore that gap until they cannot. He then looked at derivatives. Open interest in futures contracts remained large compared to registered physical supply. Paper claims on silver exceed the amount of silver readily deliverable in vaults. This structure has existed for years, and it does not automatically signal crisis. Derivatives markets rely on the assumption that most participants settle in cash, not metal, but assumptions can shift. If even a small percentage of participants begin demanding physical delivery rather than rolling contracts forward, leverage magnifies stress. Coverage ratios tighten quickly. Exchange rules can adjust. Delivery allocations can be restricted. Premiums can widen between regions. Those are not theoretical risks. They are structural vulnerabilities. At the same time, geopolitical fragmentation adds complexity. Trade relationships are shifting. Export controls on strategic materials have increased globally. Nations are becoming more protective of resources tied to energy transition and defense industries. Silver sits inside that category. When geopolitical tension rises, resource nationalism often follows. Countries secure supply for domestic use before exporting freely. This does not immediately cause shortages, but it increases long-term uncertainty. Uncertainty raises prices before scarcity does. Then there is the industrial transformation underway. The global push toward electrification and renewable energy is not slowing. Solar panel production continues expanding. Electric vehicle adoption remains a priority in multiple regions. Artificial intelligence infrastructure requires massive energy and advanced circuitry. Each of these sectors consumes silver. This creates a rare situation, a monetary metal with growing industrial dependency. Most commodities fall clearly into one category or the other. Silver bridges both. When financial demand and industrial demand move in the same direction, price elasticity tightens. That alignment can be powerful. He then examined liquidity conditions. When markets become unstable, capital seeks a depth. Silver markets are deep, but not as deep as major currency markets. Rapid institutional repositioning can move price disproportionately because total market size is smaller relative to global bond or equity markets. $300 billion is significant in silver. It is modest in global equities. That relative scale amplifies movement. Still, he did not ignore counterarguments. Rapid surges can reflect algorithmic triggers rather than structural change. Momentum funds often respond to breakouts. Short positions can unwind quickly, creating temporary squeezes. If that is the case, price could retrace once positioning stabilizes. But short covering alone rarely aligns perfectly with industrial fundamentals and physical vault trends. This is where suspense enters. Not emotional suspense, but strategic suspense. If the repricing reflects structural forces, debt expansion, industrial demand growth, geopolitical fragmentation, and derivative leverage, then this event may represent the early stage of a longer cycle. If it reflects short-term positioning and liquidity flows, then it may fade. The difference will not be visible in headlines. It will appear in data over time. Inventory levels, lease rates, delivery behavior, and premium persistence. He understood that business leaders cannot afford to dismiss either scenario. For manufacturers, a sustained silver repricing affects margins. For energy companies, it affects project cost assumptions. For investors, it alters asset allocation frameworks. For entrepreneurs building in technology sectors, it influences input risk. This is not a speculative curiosity. It is a cost variable. And when cost variables begin to move rapidly, they often signal deeper shifts in the system that produces them. Silver's 12-hour surge may be the first visible crack in a structure that has operated smoothly for decades, or it may be a volatility event inside an unchanged framework. The uncertainty is the warning. The next question is no longer, why did silver rise? The real question becomes, is the financial system still in control of silver's pricing, or is the physical market beginning to assert itself? Institutional signals, contradictions, and the quiet divide. The market surge was loud. The institutional response was not. While price charts moved sharply upward, major financial institutions released statements that did not align with one another. One bank's research desk warned of bubble-like behavior across commodities. Another raised long-term price targets for precious metals. Both assessments came within the same week. That contradiction matters. When institutions disagree publicly, it signals uncertainty privately. Markets are rarely most dangerous when consensus is strong. They become unpredictable when confidence fractures. He began by examining the so-called bubble warnings. Analysts pointed to rapid price acceleration, increased volatility, and speculative inflows. Their models flagged metals alongside other asset classes that had appreciated quickly. Historically, assets that move too far too fast often correct. The warning was rational. Yet in the same environment, another major institution raised its long-term gold target significantly, citing geopolitical risks, monetary instability, and sustained central bank demand. Their tone was not defensive. It was strategic. If gold rises under those conditions, silver historically amplifies the move. Two large institutions, two opposite narratives, same data. This is not noise. It is structural confusion. He then expanded the lens. For over 2 decades, gold has outperformed major equity benchmarks when measured over long time frames. The S&P 500 generated innovation, productivity gains, and record corporate earnings. Yet in relative terms, a passive allocation to gold held its own, sometimes surpassed, equity returns in certain multi-year windows. That trend unsettles traditional asset allocation theory. Equities represent productive enterprise. Metals represent stored value. When stored value competes with productive capital over long horizons, it signals tension in currency confidence or valuation extremes. At the same time, equity valuations remain elevated by historical standards. Earnings yields sit near levels last seen during late-cycle optimism periods. Debt-financed buybacks, liquidity injections, and accommodative policy have supported asset prices for years. If confidence in that structure weakens, capital rotates. Rotation does not happen gradually forever. Sometimes it accelerates suddenly. Silver, unlike gold, reacts more violently because of its smaller market size and industrial overlap. A modest shift in institutional allocation can create amplified price movement. That amplification can appear speculative, but it may simply reflect scale. He then looked at volatility indicators. Silver lease rates had recently fluctuated sharply before easing. Such movements can reflect short-term supply stress or technical positioning adjustments. Falling lease rates might suggest temporary easing in physical tightness. Rising lease rates often signal scarcity or demand pressure. The volatility itself is the signal. Stable markets do not exhibit extreme lease rate swings. They move within narrow bands. Rapid shifts imply imbalance, either in perception or in physical flow. Then there is media framing. Mainstream financial coverage often attributes metal demand to seasonal buying or regional gift traditions. Such explanations are not false, but they are incomplete. Buried inside those reports were mentions of supply constraints and persistent premiums. When media acknowledges constraint quietly, it often reflects information already visible in data. The market may be adjusting before headlines fully adapt. Still, the bearish case remains viable. Derivative markets possess deep liquidity. Large institutions can hedge aggressively. Concentrated short positions can cap rallies temporarily. Past settlements and regulatory cases confirm that precious metals markets have experienced manipulation. Yet those cases also demonstrate durability. Suppression mechanisms can persist longer than expected. History does not promise imminent resolution. If leverage remains manageable and delivery demand stays contained, price could stabilize or reverse. Momentum-driven inflows can unwind quickly. Risk assets can regain favor if macro conditions stabilize. This is where the divide becomes clear. One side sees volatility and warns of overheating. The other sees structural tension and anticipates repricing. He did not choose sides emotionally. He observed incentives. Banks operate within balance sheet frameworks. They assess risk relative to exposure. A research desk warning of bubbles does not necessarily imply imminent collapse. It reflects sensitivity to momentum risk. A raised target reflects long-term scenario modeling. Both can be correct over different time horizons. The deeper suspense lies elsewhere. If institutional players quietly accumulate while publicly warning of bubbles, that divergence becomes important. If central banks continue increasing gold reserves while cautioning about metal speculation, that contrast matters. Public narrative and private positioning often diverge. He also considered global capital flows. Emerging market economies increasingly diversify reserves away from a single currency anchor. Resource security becomes strategic in fragmented geopolitical landscapes. Commodity nationalism grows, export controls tighten, supply chains regionalize. Silver sits inside that transformation. If geopolitical tension escalates or trade flows adjust further, physical premiums could widen. That would challenge paper pricing mechanisms. The greater the divergence between physical demand and derivative pricing, the more unstable the equilibrium becomes. Equilibrium rarely breaks gently. Markets function on confidence that contracts can be settled smoothly. If confidence weakens, whether due to delivery allocation limits, inventory drawdowns, or persistent premiums, the psychological shift can move faster than supply itself. He returned to the core question. Is this surge a volatility spike within a controlled system? Or is it the first visible signal that the system controlling pricing is under strain? Institutions do not announce strain, they respond to it. The contradiction in their messaging may be the earliest clue that something deeper is shifting. The next phase will not be defined by headlines. It will be defined by behavior, by who demands delivery, who rolls contracts forward, who accumulates quietly, and who exits early. And in that quiet behavior, the true direction of silver's future will be revealed. The forward risk map. What happens? If this continues, the surge itself was dramatic, but the real question now is simple. What happens next? He did not view the $297 billion movement as an isolated event. He treated it as a stress test. Every major repricing exposes pressure points in the system. The purpose is not to predict panic. The purpose is to identify vulnerability. For entrepreneurs, manufacturers, and capital allocators, silver is not just a chart. It is a variable in their cost structure. If silver stabilizes at higher levels, margins compress in sectors that depend on it. Solar producers, EV manufacturers, semiconductor firms, and advanced electronics suppliers must revise projections. Long-term contracts may need renegotiation. Hedging strategies may need expansion. But if silver continues rising rapidly, the implications extend beyond cost. It becomes a signal. A sustained rise could indicate tightening physical supply. It could reflect capital rotating away from paper assets. It could reveal increasing distrust in fiat purchasing power. Each scenario carries strategic consequences. He began mapping possible paths. Scenario 1. Delivery pressure intensifies. If physical demand continues rising and more participants request delivery rather than rolling contracts, exchanges may adjust rules. Allocation limits could tighten. premiums between regions could widen. Paper pricing might struggle to suppress physical demand signals. Under this scenario, volatility accelerates. Businesses face procurement uncertainty. Inventory management becomes critical. Strategic stockpiling increases. In this case, silver becomes less of a trading instrument and more of a strategic asset. Scenario 2, paper markets reassert control. If open interest declines and speculative positions unwind, volatility could fade. Delivery pressure may ease. Lease rates may stabilize. The recent surge could retrace partially, restoring equilibrium. Under this scenario, the event becomes a temporary spike. Businesses return to predictable pricing. Capital flows back toward equities and bonds. But such stabilization requires confidence. Confidence that vault inventories are sufficient. Confidence that derivatives exposure remains manageable. Confidence that industrial demand growth will not outpace supply. If that confidence holds, pricing stabilizes. If it weakens, volatility resumes. Scenario 3, gradual structural repricing. This scenario is less dramatic but more powerful. Instead of collapse or explosion, silver trends upward steadily over months. Physical premiums persist modestly. Institutions quietly adjust allocations. Industrial users hedge more aggressively. There is no crisis headline. There is only steady repricing. This is often how structural shifts unfold, slowly, then suddenly. He emphasized one point repeatedly. Business leaders must watch indicators, not emotions. The indicators are measurable. Registered inventory levels, open interest relative to physical supply, lease rate volatility, premiums between exchanges, delivery allocation rules. If inventory continues declining while open interest remains high, risk increases. If premiums widen while futures pricing remains subdued, divergence deepens. If delivery rules tighten again, structural strain grows. These are not speculative ideas. They are observable data. He then considered the broader macro backdrop. Equity markets remain elevated relative to historical earnings yields. Debt burdens remain heavy. Central banks balance inflation control against financial stability. Governments continue large fiscal commitments. In such an environment, hard assets serve as quiet hedges. If silver's surge reflects capital questioning systemic resilience, then ignoring it carries risk. He did not frame this as alarm. He framed it as preparation. Entrepreneurs building technology companies must understand input cost risk. Investors allocating capital must understand asset rotation dynamics. Manufacturers must understand supply chain fragility. Silver's role intersects with all three. There's also a psychological dimension. Markets operate on narrative. For years, paper pricing mechanisms functioned smoothly. Few questioned delivery assumptions. Few examined coverage ratios. Few monitored vault flows daily. That complacency may be changing. When more participants begin verifying physical backing instead of assuming it, pricing dynamics shift. Confidence is invisible until it cracks. He returned to the 12-hour surge. $300 billion does not appear from nowhere. It reflects repositioning. It reflects urgency. It reflects perception that risk or opportunity has changed. The question is not whether silver is volatile. The question is what volatility is signaling. If this was simply momentum, it will fade. If it was structural, it will compound, he concluded with clarity. Markets rarely send warnings in comfortable language. They send them through price, volume, and divergence. Those who dismiss early signals often react later at higher cost. The disciplined approach is neither panic nor complacency. It is observation. Track delivery behavior, track inventory trends, track industrial demand data, track institutional positioning. If physical and paper prices converge smoothly, stability returns. If divergence widens, the system faces adjustment. Silver's 12-hour surge may prove temporary, or it may be remembered as the first visible tremor before a broader shift in how capital values tangible assets in a leveraged world. The data is public. The indicators are measurable. The implications are strategic. What remains uncertain is not whether something moved, it is whether the movement was the beginning.